If you've ever looked at your tax return and thought, where did this number even come from? There's one number that quietly controls almost everything on your return. It's called your adjusted gross income, or AGI. And here's the part most people don't realize. Your AGI doesn't just affect how much tax you pay. It controls whether you qualify for deductions, whether you qualify for credits, how much of your income is taxed, and even how much you might get back as a refund. So in this video, I'm going to break this down in a way that actually makes sense. No confusing tax jargon, no complicated formulas, just a clear, step-by-step way to understand how to determine your AGI, why it matters so much, and how small changes can impact it. Let's start with the simplest definition. Your adjusted gross income is your total income minus specific adjustments. That's it. But of course, the details are where things get interesting. So let's build this step by step. First, we start with your total income. This includes everything you earn during the year. Your salary or wages, business income, freelance or 1099 income, rental income, interest and dividends, capital gains. Basically, if money comes in and it's taxable, it's part of your total income. Now here's where most people stop. They think, okay, that's my income, but that's not your AGI yet. Now we move to the second step, adjustments. These are specific deductions that reduce your income before taxes are calculated. And this is what transforms your total income into your adjusted gross income. Let's talk about some common adjustments. Contributions to certain retirement accounts, like traditional IRAs, student loan interest, health savings account contributions, educator expenses in some cases, self-employment tax adjustments. Each of these reduces your total income. And here's why that matters. Because every dollar you subtract here lowers your AGI. Let's pause for a second. Why is AGI such a big deal? Because it acts like a gatekeeper. Many tax benefits are based on your AGI. If your AGI is too high, you may lose access to certain credits or deductions. If your AGI is lower, you may qualify for more benefits. So even a small change in AGI can have a ripple effect across your entire tax return. Now let's walk through a simple example. Let's say you earned $80,000 in total income. That's your starting point. Now imagine you contributed $5,000 to a retirement account and paid $1,000 in student loan interest. Those are adjustments. So now we subtract $6,000 from your total income. That brings your AGI down to $74,000. That one change, just $6,000, can affect multiple parts of your tax situation. Now let's take it a step further. After AGI is calculated, you apply either the standard deduction or itemized deductions. But those come after AGI. That's why AGI is so important. It's not the final number, but it influences everything that comes next. Now let's talk about something that confuses a lot of people. AGI versus taxable income. These are not the same. AGI is your income after adjustments. Taxable income is what remains after further deductions are applied. So AGI is like the middle step. It connects your total income to your final taxable income. Moving forward, let's talk about where you actually find your AGI. If you filed taxes before, your AGI is listed on your previous tax return. And here's something interesting. The IRS often uses your prior year AGI to verify your identity when you file electronically. So it's not just a calculation, it's also part of how your return is processed. Now let's shift into something practical. How do you actually determine your AGI step by step? First, gather all your income documents, W-2 forms, 1099 forms, investment statements, any records of additional income. Second, calculate your total income. Add everything together. Third, identify your adjustments. Look for eligible deductions like retirement contributions, student loan interest, or HSA contributions. Fourth, subtract those adjustments from your total income. That final number is your AGI. Simple in theory, but powerful in impact. Now let's talk about something that most people overlook: control. Your AGI is not completely fixed. There are ways to influence it. For example, contributing to a retirement account before year-end, making HSA contributions, managing certain types of income. These actions can reduce your AGI, and when your AGI decreases, you may unlock additional tax benefits. Now let's be clear, this is not about avoiding taxes. It's about understanding how the system works so you can make better decisions. Now let's address a common mistake. Many people focus only on their total income. They think, I made this much, so that's what matters. But in reality, AGI often matters more because it determines eligibility for many tax rules. Ignoring AGI is like ignoring the rules of the game. Now let's talk about something that makes this even more important: phase-outs. Certain tax credits and deductions start to disappear as your AGI increases. For example, credits related to education or retirement contributions may be reduced or eliminated once your AGI crosses a certain threshold. So if your AGI is just slightly above a limit, you might lose a benefit completely, but if you reduce it slightly, you might regain that benefit. That's how powerful this number is. Now let's bring this into real life. Imagine two individuals with similar incomes. One plans their adjustments carefully, the other does not. The first person lowers their AGI and qualifies for additional credits. The second person does not. Same income, different outcome. That difference comes down to understanding AGI. Let's shift into something practical again. If you're using tax software, AGI is calculated automatically. But just because it's calculated doesn't mean it should be ignored. You should still understand how it's being determined, because awareness leads to better decisions next year. Now let's address something quickly. What if you don't know your prior year AGI? You can retrieve it from your previous tax return or request a transcript from the IRS. This is especially important when e-filing. Now let's step back and summarize everything. Adjusted gross income is your total income minus specific adjustments. It's not your final taxable income, but it plays a critical role in determining it. It affects your eligibility for deductions and credits. It influences how much tax you pay, and it can be managed with the right planning. Here's the key takeaway. Taxes are not just about how much you earn. They are about how your income is structured, and AGI sits right in the middle of that structure. If you understand this number, you understand a big part of your tax return. If you ignore it, you're missing one of the most important levers available to you. If this video helped you finally understand AGI in a clear and practical way, subscribe to our channel. We simplify complex tax topics so you can make smarter financial decisions without feeling overwhelmed. And if you want to learn more about how tax planning can help you control key numbers like AGI, visit GavTax.com for deeper insights. Thanks for watching, and I'll see you in the next video.